Good morning. This is Larry McMillan with a stock market update on Monday, February 28th. The market did sell off sharply last week and then rebounded. So we might be in another oversold rally, although news events overnight sent the market down another 100 points from which it's trying to recover right now. But in a broader sense, the trend of the S&P chart is still down. If you look at the chart, you can see a series of lower highs and lower lows, and that's negative. So as long as that's the case, we're taking a cautious attitude. We're maintaining a core bearish position on this market. Specifically, S&P has support. Last week it found it just above 4,100. Previously had found it near 4,200. So that kind of general area in there is still a support level. An oversold rally can continue back towards the declining 20-day moving average, which right now is at 44.50. Above there is resistance at 4,600. And then if S&P were to break out over 4,600, that would be bullish, and we would have to reconsider whether it's still in a downtrend or not. Moving on to put call ratios, both our equity-only put call ratios are now on buy signals, and those are confirmed by the computer analysis programs that we use. They're coming from very high levels on the chart, meaning they were very oversold before they rolled over to buy signals. So in general, those are good buy signals, and they're more of an intermediate term nature. So that is one encouraging feature that's not just a short-term thing. Breadth has remained quite negative, though. It improved a little bit on Friday, actually quite a bit on Friday. But right now, the oscillators are still on sell signals. However, if we were to get positive breadth today, we would get some buy signals from the breadth indicators. Overnight, as I said, the market opened sharply lower. It's still down about 40 points or so on S&P terms. So that won't that won't help breadth on the opening, but we'll see how it is by the close of today. New highs versus new lows remains a very negative factor as many stocks continue to make new 52-week lows. Volatility indices and VIX and all the volatility products are still struggling to maintain a bullish attitude. VIX did rise up last week and then fell back, giving a VIX spike peak buy signal as of, I believe, Friday, or maybe even Thursday. And that was, another short-term positive. However, we've had a series of those that haven't been working out too well. I think one did, a couple did not. So that's a bouncing kind of indicator that now is back to the positive side, which would align with an oversold rally. The more important trend of VIX, however, is still upwards. And when VIX is trending upwards, that's bad for the stock market. So unless VIX were to fall back to 20, actually below 20, it would still remain in a negative trend. The construct of volatility derivatives basically has to do with the term structure of the futures. That remains negative as well. And until that improves, that's an intermediate term negative for the market. So overall, right now we have S&P, the index, trending down and VIX trending up. And those two things combine to produce, in my opinion, a bearish overall scenario. And until those trends are broken, we will maintain a core bearish position. However, we can trade some of these other buy signals around that, these buy signals that come up from oversold conditions, one of which is the VIX spike peak that just occurred. So I invite you to visit our website, check out our newsletters where we talk about these things daily, and have a great week trading.